Welcome to Get Rich Education. I'm your host, Keith Weinhold. As we navigate further into pandemic times, we're gaining clarity. We're learning just how much can you count on tenants to pay the rent, how much risk exists with home prices dropping, and how does a real estate investor adjust today? Understand that mortgage forbearance is saving you, even if you don't use it. Also, a friend of the show is dropping by to help you out today on Get Rich Education. Finally, with Total Control Financial, get checkbook control of your existing 401k and IRA funds to invest in real estate. Yes, you can move your retirement money into your own checking account, but you must avoid the little-known tax that you'll get hammered with in a self-directed IRA. Instead, start your QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Jackson, Mississippi to Jackson Hole, Wyoming to Jacksonville, Florida, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. It is a salient time to talk with a company that manages thousands of rental properties. That's just what we're doing today, because with a big sample size like this, we can see what percent of tenants are paying the rent early, what percent are paying on time, what percent are paying late, and how many tenants haven't paid at all. Also, we'll discuss, could property prices fall, as most believe that a vaccine won't arrive for months, and we try to mitigate effects with more COVID testing and contact tracing. There's still not any life post-coronavirus. There's only life with coronavirus. Most real estate investors don't have much of a problem with occupancy right now. Units are occupied, including my own, but I have just a couple tenants that can't pay the rent. Well, my risk is that I'll never get the rent and that I cannot evict them in the meantime. That's my risk. This is what's called, as they say, the difference between economic occupancy, meaning the dwelling is occupied with a paying tenant, and mere physical occupancy, meaning that it's occupied with a non-paying tenant. Now, no two crises are the same, and the Great Recession from 12 years ago had speculative housing and irresponsible lending at its epicenter. That was a real estate-born crisis, in fact. This crisis now is not real estate-born. It's the unemployment that the virus has caused, and investors won't receive the official look at the U.S. unemployment rate for last month, which was the first full calendar month of unemployment effects from this. They won't get a look at that number until May 8th. That's when you'll learn what the unemployment figure is. This all has to do with rent income, your rent income. Now, when it comes to the subject of housing prices, last week I discussed forbearance here on the show, which means that ability to postpone your mortgage payments. Understand forbearance's stabilizing effect on housing market prices. Look, just imagine if there were no such thing as forbearance and there were no option. Well, then people that couldn't afford their mortgage payments, they'd have to put their home on the market. They'd have to put their home on the seller's block then, because they couldn't afford the payments. They'd lose their home, move from their home, and then prices might fall. That's why forbearance supports housing prices, and that's why it helps you even if you don't use forbearance yourself. Let's not lose the point as well that some primary residence dwellers would be out on the street without it. Today's guest is a friend of Get Rich Education. He's also a GRE listener himself, like many of our guests are. He told me before our chat that he's going to make a pretty exceptional invitation for you, and it's just for Get Rich Education listeners. He proves that he wants to see you succeed just as much as I do. Let's meet this week's guest. This week's guest is a founding partner of JWB Real Estate Companies, and they serve over 1,000 clients across 43 states and 13 nations. They've purchased and renovated thousands of investment properties, and they've currently got over 3,000 properties under management. So he's great to talk to on getting the temperature of the market. An 8-time honoree of Inc.'s fastest growing companies in the U.S., they've been featured in the Wall Street Journal and New York Times, and they've really been outstanding about giving back to their own community, which is their home base in Jacksonville, Florida. Welcome back to Get Rich Education, Greg Cohen.
Hey, Keith, so glad to be here. Thanks for having me.
Greg, I think there are 3 big questions on the minds of rental property investors today. So let's break down each of these. First, they're thinking, now, can I count on rent collection during a pandemic? Secondly, they're thinking, is there a risk with home prices dropping during coronavirus? And then thirdly, they're thinking, now, would it be better to buy property today or say 6 months from now? So with that first one, what do you think about one counting on rent collection? Of course, it can never absolutely be guaranteed or counted on, even in good times. But what has your experience been in there, since you do have your property management division and you can see how the rents are coming in?
Yeah, absolutely. I think it's really wonderful to be able to be transparent and use these 3,500 data points that we have, or the number of homes that we manage here in Jacksonville, and give you an informed perspective. And I think perspective is really important to go into this conversation with, right? We need to think about why people were coming to rental property investing for decades now. And, the ability to create consistent returns through rental income and rent collection has been a time-tested and proven way to generate consistent returns. That's why people come to this asset class. Now, we know that, but then you've got this huge disruptor with coronavirus, and the news has been staggering, right? We've had over 20 million unemployment filings. We lost over 700,000 jobs in March. Evictions have been halted across the country for up to 4 months, depending on the type of mortgage that you have. So I know it understandably causes some concern for rental property investors, causes us to take a pause and say, is it still as consistent, right?
Right.
But I think what's really important is for everybody to keep in mind that you want to be investing in something that is a critical need always, and especially in a time like this. Housing is a critical need for the individual, but housing is also a critical need for the government. And this protects your downside risk to your investment. This is why people have considered rental property investor a consistent generator of returns. It's because you're investing in a critical need. And that's what we're seeing here as we look into the numbers here as far as rent collection.
That's right. The government historically supports housing. We're talking about providing people with shelter. That's the sort of thing that the government steps in and makes sure that the safety net's there, or the economy would be chaos without housing for people. So we're not talking about supporting theme parks with roller coasters or supporting swimming pools. We're talking about supporting things that people need here. So really, at a time like this, there's a few things that are the goal. We want to retain our occupancy. We want to keep that tenant in there, and we want them to pay the rent. We also need to show some compassion and empathy when it comes to that rent collection with the tenant.
100%. Those two things are so important right now. Compassion and occupancy are the most important. And what investors need to realize is that you're going to maximize your long-term return on investment, even if there is a short-term temporary loss of rental income because of focusing on occupancy and compassion. Number one, it's just the right thing to do, but it will make you money in the long run. And everybody needs to have that long-term perspective like you talk about all the time, Keith. There's a few things that you can do for those who manage their own properties that are listeners, or if you are managing your property manager. These are some things that we are doing at JWB that I know are helping with our rent collection numbers, as well as the compassion that we're able to show for our residents. Number one, you want to openly communicate with your residents. This should be a no-brainer. It's amazing in tough times how the general reaction for people and companies is to kind of shelter themselves. But this is a time for outreach, to be talking to your residents in all the different forms of communication. You want to be offering hardship assistance, be proactive to go and find that assistance for your residents, and then be offering it to those residents. Waiving late fees is something that we've done. It has gone over tremendously well with our residents, and it's something that I would recommend in the short run here as well. And just be very flexible with your payment plan options. The compassion, the flexibility you can show right now will go a long way for some of those residents who are really, really struggling this time.
How often have you had to waive late fees? And another way to ask that is, how often are tenants paying the rent late and how often are they not paying it at all?
Well, we have waived it across the board in the month of April, right? We're operating on a very monthly schedule at this moment because there's just so much news and information coming. So we make decisions for the month at the moment. Residents, there's a large percentage of residents that while we're all affected by coronavirus, it hasn't affected their ability to pay rent. So what we track is the percentage of rent that's been collected before the first of the month, and we track the percentage of rent that's collected by the 6th and all down the line. And what we've been able to see is that those percentages of rent collected by those key milestones is largely in line with a normal month. So to answer your question is, in the past, those residents that did not pay late fees, they probably didn't need to pay them this month. They already paid their rent prior to the 1st or on time. Now, those who do have a hardship or did have a flexible payment plan that we needed to work with them on, those residents, we were able to waive the late fees for those folks. And it's been largely very, very well received.
Just to be clear, Greg and I are talking about not waiving the rent, but waiving the late fee because you do need to be paid the rent. So we talk about showing empathy for the tenant and being flexible with them. Part of that might be offering to let them pay by credit card and waiving the credit card fees for them if they don't have the cash. Or part of that might be something I think is poor advice in conventional times, which is perhaps offering them an installment plan. And then there's also, if you can communicate to the tenant that they have some empathy for you, the investor. And what I mean by that is most tenants don't realize that you have a mortgage to pay. And a lot of tenants just don't understand the economics of renting property at all. In fact, not that we would ever operate this way, Greg, or buy our own property this way ourselves. But some tenants don't realize that even if they pay the rent, that investor is cash flow negative anyway. So it's really not that this property owner is so wealthy and they're going to go out and buy a flat screen TV with their $1,200 rent. It doesn't work that way at all. So there's really compassion and understanding both ways, having empathy for the tenant, but making sure that the tenant understands that investor situation as well.
That's the beautiful part of working relationships, right? And a lot can be solved, but you have to do it through a positive, effective communication. Those property managers or those landlords that have never talked to their residents other than to try to collect rent, they're really at a disadvantage right now. They can't lean on those past conversations, the past times that you did something nice for your resident. If you're viewed as only as a bill collector right now, you are going to really, really have a hard time connecting with your resident, having compassion, and then ultimately working on a plan that can benefit everybody in the long run.
That's a great way to think about it. And oftentimes these tenants have access to stimulus packages. So talk to us about how you've seen the stimulus packages, like, for example, the $1,200 direct payments that went to everyone below a certain income level and how that's helped tenants pay the rent.
This is so huge, I think, for rental property investors, Keith. What we're seeing here is because this is a critical need for the government, housing is a critical need, the government is doing their best to not let what I know you call the great shutdown, and I think that's a great terminology for where we're at with the coronavirus pandemic here in the States, but they don't want the great shutdown to turn a health and a financial crisis into a real estate crisis. And they have the tools to be able to have a positive effect to not let that happen. So this stimulus package, while most of the headlines were made about that $1,200 direct payment made to individuals based on income, what many rental property investors and the general public don't understand is how the unemployment benefits work. But this is going to have a dramatic impact on rental property investors more than many realize.
That's a good point. We think about the stimulus, but we don't think about what the unemployment package looks like.
Absolutely. And when I learned about this, even I was surprised. So I'll share what I know about it and how it's going to affect rent collection in the future here. See, when the government was putting the stimulus package together and understanding how unemployment was going to work, they fully understood that there were going to be a tremendous amount of unemployed folks. They're doing their best to keep people employed, but the reality is that there was going to be massive unemployment filings. And the government's intention was to create a situation where they knew that people would make as much money being unemployed as when they were working. Which sounds crazy, doesn't it, Keith?
It does.
But they knew if they didn't do this, it would make the health and the financial crisis worse, because if people can't pay their rent and they can't pay their mortgage and they can't pay their bills, they would inevitably look for work and they would go outside and potentially spread the disease more. This would have been a very bad thing. So the way unemployment works, typically unemployment benefits work in a way where if somebody goes on unemployment, they receive somewhere between 40 to 60% of what they were earning before they became unemployed. It varies per state, but in the state of Florida, the max weekly payout is actually $275 per week.
I didn't realize that. I learned something. Okay, $275 a week is the maximum unemployment payout. This is separate from any stimulus package.
Exactly. That was pre-coronavirus time. You could earn a maximum of $275 a week. Now, the CARES Act comes. And now that same person who's unemployed gets an additional $600 per week for the first 4 months.
An additional on top of the 275 maximum?
Exactly. Do you want to know why they chose $600, Keith?
Yeah. Why anyway?
Well, the original intention is to give people 100% of compensation, like we were just talking about. But they went to the states and they tried to adjust the state unemployment benefit programs to just change from 40 to 60% to 100%. And do you know what the state's response was?
What's that?
Our systems are so antiquated, we can't figure out how to do that. Yeah. So the government, not having much time, they did a calculation and they basically said that $600 per week is going to be the best that we can do to get this thing out quickly to add to the unemployment filings. So what this means is for many low dollar per hour workers who are unemployed, they are definitely going to earn the same amount being unemployed as when they were employed. And many will actually make more being unemployed than when they were employed. If that doesn't seem a little unique, I don't know what does.
Yeah, among these people, that doesn't really even incentivize them to want coronavirus to end. But in any case, it's good to know that our tenants might be able to afford the rent payment.
That's where it's going. Whether or not this is a good thing and how we did it is perfectly for another podcast to talk about, right? But the reality is this is what is going in the pocketbooks of your residents. And this is why there is not another type of investor who's set to benefit more from the CARES Act and the unemployment benefits that are a part of it than rental property investors. It's because you're investing in that critical need, and that's going to have a significant impact on rent collection in the future.
And they also extended who is eligible for 1099, which are contractors and gig economy workers, and they extended benefit duration.
Absolutely. So you think about the big impacts here as far as ability to pay rent. That stimulus of $1,200, the direct payment, certainly is helpful to folks, but the longer impacts to be able to pay rent are actually from the unemployment benefits of which you just mentioned.
You have anything else on what's happened so far with your rent collection?
Yeah. I thought this would be a great time to just give real transparent data, knowing that we do serve so many residents out there and have collected rent here now. So I thought I would tell people exactly what we're seeing here in our first month here during coronavirus and how rent collection has fared.
Yeah.
Typical month at JWB sees us collect about 98.5% of rents, right? That is pre-coronavirus time.
That's outstanding.
Well, thank you. It takes a lot of hard work, but it's a lot of that relationship that we have with residents to be able to do that. But that's sort of the standard for us. Now, prior to coronavirus, there was the March rent collection. By the time the full brunt of coronavirus had hit and social distancing, March had already had the beginning of it happen. And so you had what I would say is a normal rent collection environment for, the beginning of March.
Yeah, the world started to get weird around mid-March.
Exactly. But you still had the second half of March where the world was weird and the fear was at an all-time high and people lost their jobs. What was really exciting to see is that total rent collection for us through March came out to 98%, which was a great statistic to see that even though there were some challenging times, rent didn't fall. So that was our first positive statistic there.
That high rent collection rate is a testament to good tenant placement in the beginning when that tenant comes in.
The way to succeed in rental properties non-coronavirus time is very clear. You have to put the right resident in there. You have to treat them like gold. And that's mainly what you're seeing with those March rent collection numbers being 98%. But then the big question is, what's happening in April? This was the first time in a coronavirus world to see what rent collection numbers would be. And the general pulse of the investing public out there is people are scared, right? Can you even collect rent? Knowing that many times, not saying that we would evict in a time like this, but knowing that there's no consequence for not paying rent as far as an eviction, how would that affect rent collection, which I'm sure is on the mind of a lot of your listeners. So I'll go ahead and give you the stats that we saw come April, okay? Yeah. So historically, as I was mentioning earlier, before the first of the month, we always track. So that was our first indication. So how much rent did we collect prior to April 1st for the month of April? And historically, we collect between 15 to 20%. In the coronavirus time prior to April 1st, we collected 17%. So it's right in line with a normal month for us, a really positive sign. By the 6th of the month, we typically collect 70% of rent collected. For us, by the 6th of April, guess what we collected?
Sounded like 70%.
70%, right in line. Now, these are really two fantastic metrics. I must share with you, we've been doing this for about 15 years now. I have never watched rent collection numbers more on an hourly basis, on a daily basis, than I did March 31st, April 1st. My business partners and I, we were completely locked in because this is new for everybody. We did know this is consistent. It's a consistent asset class, but we were all in this together. And so we were right there at 70%.
You're looking at that thing more often than a stock trader checks their stock ticker terminal.
Which is not normal for a rental property investor. But right now we had a lot of folks depending on us to do this the right way.
Real estate is such a slow moving asset class, but not lately.
Just think about all the news that has come out. It's like one major news cycle right after another. So yeah, if you're not paying attention to this right now, you're behind the game.
It's a lot to keep up with. So it sounds like the takeaway there is that the sky isn't falling when it comes to rent collection for you. Greg, so tell us about how the rent collection numbers have actually looked.
So we're going to be right at about 90%. And what that means to me is, listen, it's not 98.5%, right? That's not a normal month for us, but it also means that the sky is not falling and that this is a consistent asset class. In fact, when you buy a rental property, you would likely be placing a factor in there for expected maintenance and vacancy costs. So any short-term loss of rental income, at least a portion of that is captured there. And so, when you compare this to the other asset classes, what we're seeing is exactly what we expected to see. A high floor consistency is why people come to rental property investing. And even in a month where the world changed completely, it's what we're seeing here as well.
Yeah, that's some good perspective. If you would have asked someone a year ago, what's the worst situation you could possibly think of and how would that look? That's really about what we're talking about here.
Absolutely.
Well, Greg and I have more to talk about. We want to talk about what's on the top of your mind, and that includes, is there a risk with home prices dropping? And would it be a better time potentially to buy more property today or to wait for 6 months? You're listening to Get Rich Education. Our guest is Greg Cohen. More when we come back. I'm your host, Keith Weinhold. Property investors can get killed with maintenance costs. That's less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in bustling Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental property. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, start now at newconstructionturnkey.com. The company that's provided our listeners with more loans than anyone is Ridge Lending Group, NMLS 42056. You can finance more than 10 single families up to fourplexes. Serving most U.S. states, their knowledge and experience leads to your financial freedom. They're number one in the investment space. Pre-qualify and then chat with President Chaley Ridge personally. Start on your next investment property loan right now at ridgelendinggroup.com.
This is Rich Dad Advisor Tom Wheelwright. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Greg Cohen of JWB Real Estate Companies. He's a great person to talk to for a lot of reasons. He's been in the business a long time, and their company manages over 3,000 properties. So it's really a great way to get a temperature of the market. And Greg, I want to talk about the prospect of home prices potentially dropping during coronavirus, and if that's a risk. And of course, it's a risk. There's a prospect of home prices dropping even during good times. Greg, before we hear from you, I just want to give some perspective overall on being a real estate investor. And a lot of this comes back with understanding your 5 simultaneous profit centers. And I want to paint a really bad scenario. What if properties got 0 appreciation in this next year, and you also had 0 cash flow in this next year? Well, besides that, you're typically going to have a 5% return from loan amortization. That's the annual principal paydown that your tenant makes for you, divided by your skin in the game as the investor, divided by your down payment and closing costs, that is. So that's 5%, 5% from the tax benefits, plus 2% from inflation profiting. Well, that right there, 5, 5, and 2, that's 12% annualized return for you. And that's with 0 appreciation and 0 cash flow. I cut the primary 2 profit centers down to their knees right there. So that's the benefit of investing in something that has multiple profit centers like this. But when it comes to home prices, Greg, sometimes we see things out there like banks raising their mortgage qualification standards. A while ago, Chase, for example, said that you now need to have a 20% down payment and a 700 credit score for primary residence buyers. Well, that can affect us in the 1 to 4 unit space. For someone that doesn't understand that, just to give it an extreme example, is what if the credit score minimum were now 800? Well, now not very many people could buy homes any longer. The demand for homes would evaporate, and that could cause a down drain in prices. I don't think we're going to see anything like that, but we have seen more stringent loan qualification standards. So kind of with that backdrop and that understanding, Greg, and of course, we never know the future directions of things. What are your thoughts about future home price appreciation?
Well, this is a common question right now. People, I think, look at it from 2 perspectives. Number one, they think, what is this going to do to my long-term return on investment? And then you also have those investors out there that say, well, should I be buying a rental property today? Or if I wait 3 months or if I wait 6 months, am I going to be able to buy that same property for a lesser amount? And there's a number of factors that I think we need to look at to really help and guide and educate those who have those questions. The first thing for me is that, so everybody can understand where I was prior to the Great Recession, I bought about 40 rental properties in 2006. So I saw probably the worst time to go out there and buy rental properties.
Yeah, that's rough timing.
Many people would agree. And then I lived through the Great Recession. I still have those rental properties today. And I've seen a couple of things. Number one, I've seen that home prices actually have a rhythm to them. Home price appreciation has a rhythm to it. In fact, if you look over market cycles, which are defined between 10 to 20 years, what you'll find is that home prices and home price appreciation actually reverts back to their historical norms for a specific MSA, for a specific region, right? So if you know what the long-term historical appreciation rate is in your region and you buy and hold for a 10 or 20 year period, most likely your long-term appreciation, no matter what happens in between those 10 or 20 years, is going to come right back to the norm, which absolutely surprises most people, Keith.
Yeah. So I know you look at potential home price appreciation through a supply versus demand lens, and that has to do with the months of inventory in a particular market as well.
Absolutely. So now that we know that long-term, no matter what happens in the short run, if you have a buy and hold mentality, your appreciation is going to largely be what the historical appreciation rate is. We can take a closer look at what's going on here and now. And the best way to look at that is months of inventory. I did want to add one thing just to kind of let people know, since I was investing in 2006 and I lived through the Great Recession with my investments. If you actually go back from 2001 all the way to 2020, right, that market cycle that I've been talking about, specifically in Jacksonville, and you look at average appreciation rates, even though you had the Great Recession where values dropped 35% from 2007 to 2011, even though that happened, your average appreciation rate in Jacksonville is 4% per year, which is exactly what the historical average is since 1991. A fun fact there, and it should give everybody confidence to know that we should be making long-term decisions, and that pricing in the short run is the least most important decision factor in your decision for investing in rental properties.
Yeah, and that's remarkable that it could fall off a cliff like that with a 35% decline over a few years coming off the Great Recession and yet still hold up with that historic appreciation rate. And that historic appreciation rate is tempered on those months of inventory on the market. When we think of months in inventory on the market, classically in real estate, that dividing line is the 6-month mark. If there's more than 6 months of inventory of a certain asset type, that is then a buyer's market because there's a glut of supply. And if there's less than 6 months, there's more demand than supply, and it's more of a seller's market. So tell us about that.
That's the best leading indicator for where pricing should be and will be. And so we track that every single month because we want to understand where pricing is going. I'll give you the real numbers here. What people need to, again, have perspective is that prior to coronavirus, months of inventory in Jacksonville and in many parts of the country were extremely low. It was a seller's market. You mentioned 6 months being that equilibrium market. Well, as of April 1st in Jacksonville, we had 3 months of inventory. For the last few years, since 2016, we've been between 2 to 3 months in inventory in Jacksonville and in many other parts of the country as well. In fact, we haven't actually been to 6 months of inventory since we started tracking this in 2014. So there has been a chronic undersupply of housing in many markets across the country. And what that means is that now we know that coronavirus wouldn't have shown up in the numbers that I just shared with you yet, right? It will show up in future months of inventory. And I'm expecting that it will go up. Of course, I'm expecting that figure will go up. What that lets you know is that the runway before you would see a price decline is actually very long in terms of what month of inventory was. If months of inventory was 8 and then coronavirus hit, we would be singing a different tune as far as the potential likelihood of pricing declines.
That's right. And in the last downturn, the Great Recession of 2007 to 2009, housing supply exceeded demand. People were buying empty, vacant properties and just holding on to them for speculative reasons. And today, in this crisis, we went into this crisis with the opposite condition where housing demand exceeded housing supply. That's where we still are. You talk about 3 months of inventory. Even if that went longer, there's a substantial cushion between that 3 months and that 6-month equilibrium point. So that's an interesting way to think about it. And when one thinks about their portfolio and what they currently have in their portfolio and adding things, sometimes during a time of crisis, they think, well, now, should I continue to add property during this time, or would it be more advantageous to take a wait and see approach for a few months? And I think there are pros and cons of each, but one thing a person needs to think about is that opportunity cost of potentially waiting 6 months. Tell us about that.
Absolutely. And I put some figures to this as well, because the clients have been asking the same thing, right? We want to do what the best return, the best risk-adjusted return on investment is for all investors out there. So I put some actual numbers to it. Can I get kind of granular with numbers?
Please, let's do that.
All right. So I put this example together. You've got this investor who is sitting on $150,000 in cash, and she wants to invest in rental properties, but then coronavirus hit and maybe there was a little bit of fear and paralysis, and she's wondering whether or not she should actually invest or she should sit in cash on the sidelines. Okay.
Got it.
So for this example, she could buy 3 properties. She would finance them, and the purchase price would be $180,000 for each of the properties. The rents are $1,350. She'd put down 25% and she'd get a low interest rate loan. It would be a 30-year, very normal vanilla loan, 30 years, where your fixed payments happen all the time.
Okay.
What that would do, we won't get too caught up in the numbers there, just so you know how we put it together. But ultimately, what she's going to get in a Jacksonville rental property is a positive cash flow of $225 a month for each one of those properties. And the principal pay down, which I love when you talk about the different profit centers, Keith, right? Her principal pay down of her tenant paying down the loan for her would equal $178 per month for each one of those properties.
That's an interesting way to think about it. Yes.
So we talk about whether or not it makes sense to actually invest now, or do I wait? Well, what we really need to realize is that these are real cash events that happen in the positive. And it's one of the most beautiful things about investing in rental properties versus another asset class like the stock market. In rental properties, we've got real cash events. We've got positive cash flow happening. We've got loan pay down happening, which doesn't hit your bank account, but it really drops your loan balance. versus, many times in the stock market, you don't get monthly income from that. So the opportunity cost is not as great for stock investment as it would be for a rental property investment, right?
That's right. So how does this financing example shake out?
In this example, for this investor, over a 6-month period, let's say that they decided to invest, they would earn over $7,000 in positive cash flow and principal pay down for those 3 properties over a 6-month period. Now, what they would then need to say to themselves is, what would prices have to decline in order for that to be justified? If prices declined a lot and it evaporated that $7,000, one might make the conclusion to wait. But even before we go there, we need to understand the difference between real cash and then a loss of potential home prices on paper. Remember, Keith, I was talking about how I bought in 2006 those 40 rental properties. What do you think happened in 2007 and 2011 to real home prices and my losses on paper?
You soon learned by 2007 or 2008 that you had bought at the top.
I bought at the top. I did. Right. And it didn't affect anything about how I lived or conducted my business because I earned positive cash flow for those properties. That was the real reason why I was able to hold on to those properties. I've added a whole bunch more since. It was that positive cash flow. That's the only thing that affected my way of life. Now, on paper, my losses, while they went way down, it didn't matter to me because I had a buy and hold mentality. I was planning on holding on for forever. And now I'm 15 years later and I still own those properties as well. And the values have gone back up. There's a real value for cash events that hit your bank account versus paper losses from home prices, unless you are planning to sell in the very short term.
An appreciation loss is only an appreciation loss if you would happen to sell for less than you bought for. But when you're getting paid that monthly income stream, you're not incentivized to sell at all.
Absolutely. I analyzed the pricing in Jacksonville, and we found that pricing would have to drop a significant amount in a short period of time in order to potentially justify the waiting of purchasing a rental property. Prices would have to actually decline more than they declined in the Great Recession during the first 6 months in order to justify waiting if it was a cash purchase. And it would be a factor of how long or how much they dropped during the Great Recession. So at the end of the day, a lot of the decision for an investor is going to be, how do you feel about the positive cash flow coming into your bank account, number one. And then if you are fearful and you believe that pricing is going to drop similar to the Great Recession, well, you know what? You should probably sit on the sidelines and not invest. If you are somebody who thinks that this is a different type of problem that we're facing, right? If you think that the coronavirus is a different situation, it's a temporary situation, whereas the Great Recession was a systemic problem and was going to be around for many, many years, well, then you'd probably conclude that the opportunity cost of waiting is greater. You'd be giving up more of that cash flow than any potential pricing decline. And at the end of the day, if you're a long-term buy and hold investor, even if you get a pricing decline, it really doesn't matter. It's the least most important thing.
I just want to add, in that example you gave, the $180K purchase price for the $1,350 rent. For you, the listener, that would be a rent to price ratio of 0.75. And Greg's talking about a new construction property there in Jacksonville. I just happen to know that that's the sort of example he's talking about because I'm familiar with their inventory. And I have been inside their good product, inside their own homes in Jacksonville, and I've checked them out myself. But yeah, when it comes to should you invest now or should you invest later, well, really only you, the investor, can best answer that question for yourself. But I like to compare real estate through a lens of compared to what else could I potentially invest these dollars in. If I hold it in cash, I'm actually losing prosperity due to inflation. If I put it in stocks, that's a crapshoot. If I put it in Bitcoin, that's a crapshoot. If I put it in gold, well, over time, that really only keeps up with the rate of inflation, and that's all. Bonds aren't providing any yield. So in that example I gave, with zero appreciation and zero cash flow, you still have a 12% return when you talk about your 5% from loan amortization, your 5% from the tax benefits, and your 2% from the inflation hedging. That's 12%, even looking at a really bad scenario. It's really a question of compared to what else you would do with your money. And I know, Greg, really one of the greatest concerns for investors these days are what we started our chat with today. That being that, well, can I really count on the rent income being there? But I know for our followers, you put together something where the answer to that question for at least 6 months is a guaranteed yes. Tell us about that.
We care so deeply about setting folks up for success. I think the number one most important thing when investing in rental properties is having positive cash flow. Right now, we're dealing with an external disruptor, coronavirus. And you know how I mentioned we're at 90% for rent collected? Well, that's not 98.5% like I normally am at. So in response to coronavirus, what we're doing for our Get Rich Education listeners is we're doing what's called a mortgage payment guarantee. And this is for investors who are currently adding properties to their Jacksonville portfolio with JWB. If for any reason their residents can't pay rent at any time during the first 6 months of ownership, JWB is going to cover the mortgage payment for that investor.
That is beautiful. Thank you for doing that for our followers.
Absolutely. It just feels like it's the right thing to do at this time. Isn't something we do normally, but it is something that I think really sets everybody up for success. And for that, every investor who has that question, can I count on rent collection? This should just take that right off the table, right? This removes that chance for negative cash flow. And this is for properties that are purchased through the end of May. That is important, though. It is for new properties purchased through the end of May for our Get Rich Education listeners. And in the event that there was any disruption to the rent, JWB will actually be making a direct payment to that investor, which would equal what their monthly mortgage payment would be as a way to take care of them, even in an extenuating circumstance.
Any last thoughts, Greg, with coronavirus and real estate?
The reasons why people came to rental property investing is the reason why people are successful through coronavirus. But I also think that this is a time when you look at the effects of low interest rates that you can secure right now, historically low interest rates, and you look at the effects of the inflationary period that will be happening, many believe after the coronavirus is long gone. As you've mentioned many times, Keith, you and I both agree that rental property investors win in 3 different ways when it comes to inflation. What do we call it, Keith? The triple crown, right?
Real estate investors win the inflation triple crown when they have long-term fixed interest rate debt. That's right, because it helps with the asset pricing. It helps debase your debt more quickly when you have inflation. And then, of course, that also increases your cash flow because your biggest monthly expense, your principal and interest, is fixed.
There you go. So I think this is an opportunity for those who are in a position that they need to understand what to do with their dollars. Rental property investing has been very advantageous compared to other classes in the past, but I think it is even more advantageous to other asset classes after coronavirus is gone.
I think it's never been more important to think long-term in real estate investing. Greg Cohen, thanks so much for coming back onto the show.
Thanks for having me.
Oh, great, well thought out material from our friend Greg Cohen again today. For new buyers, those that get a property under contract by the end of this month, May 31st, if the tenant fails to pay the rent at all for up to 6 months, he is willing to pay your mortgage for you. That's their mortgage payment guarantee. The only way to get that is by getting a hold of their Jacksonville investor report through getricheducation.com/Jacksonville. Alternatively, you can go to getricheducation.com/JAX. That will take you to the same page. That is kind of Greg. What an awesome thing to do for us. And importantly, it's in part of the nation, Northeast Florida, that's seen fantastic in-migration for decades. Florida is the #1 positive in-migration state in the nation. And all their properties are brand new construction, detached single-family homes and townhomes as well. Many of our listeners have already bought and owned property with Greg for years. You know, I was just talking about Florida here on the show a couple weeks ago because I would almost go as far as to say that real estate investors should know something about Florida, and I'm pretty unemotional about that. I don't have any long-time connections like any relatives there in Florida or anything like that. In fact, I live in the state farthest from it. I do a lot of business in Florida, and I will keep doing so because I like their real estate investing fundamentals. Yes, my wife and I have been sheltering in place in our home here in Anchorage, Alaska. It's more than just being stuck inside lapping the coffee table. It's also a beautiful time of year to be here. and do great things outdoors. And I have not been in Florida for 6 months now. And yes, I've been home for 2 straight months since we were vacationing in India, Sri Lanka, and Arabia. Now the travel restrictions are on. To summarize what Greg and I discussed earlier, to optimize rent collection in pandemic times, what you want to do is increase tenant communication, show empathy by doing things like waiving late fees, providing rent payment options like accepting credit cards and waiving those credit card fees even, and then, if you must, accepting partial tenant rent payments and installment payments, things that aren't really good ideas during normal times. For real estate investors, understand that there are things that make this recession both better and worse as compared to the last recession. The good news compared to the last recession is that now housing demand exceeds supply. Now responsible lending has prevailed. Now you have super low mortgage rates. Freddie Mac just predicted that they'll go below 3%. The other plus is that leading up to this recession, there was no bubbly price run-up like last time in the last recession where you got these 20, 30, 40, and even 50% annual appreciation rates. That was nuts. This time we had a sustainable national appreciation rate of about 4% pre-crisis. This recession is expected to be more brief than the last one. Also, for the long-term good of real estate investors is that those inflationary pressures are really building as it looks like more dollars are being printed to pave over this recession with than were in the last one. But the bad part, and what makes this recession worse than the last one, is higher unemployment than the 10% peak that was reached about a dozen years ago, and that is substantially bad news. Well, that bad part is exactly what Greg and JWB's mortgage payment guarantee eliminates for new purchases made through the end of May. That is pretty cool. If the resident can't pay rent, they'll pay your mortgage for you for up to 6 months. In fact, a 90% rent collection from their managed properties was cited there in the interview. They've probably received more than that 90% by now since we recorded, even though we're in the thick of this pandemic. Now, sometimes fly-by-night companies make these guarantees that they never make good on, but that's not what this company is. They've been in business for 15 years and really have a strong company culture. A lot of employees in one central office, and I would know, not only have I been inside their investment properties in Jacksonville myself, I've been in their offices for a tour. I even did some work from their office one day. I had a pizza lunch with their staff. This can be a good option for you during uncertain times, stepping up to provide you with some certainty. Any property put under contract by the last day of this month with that mortgage payment guarantee, I would like to personally and genuinely tell you, from me to you, thank you so much for listening today and for listening every week. As a listener, you are valued to me. For brand new construction Jacksonville property that's managed by a mature company, get involved by getting the investor report that was put together just for you at getricheducation.com/Jacksonville, or save yourself some keystrokes at getricheducation.com/JAX. It takes you to the same place. I'm Keith Weinhold, returning again next week and every week to help you build your wealth. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.